if you're thinking about purchasing a new piece of real estate as a small business, I wouldn't normally tell you, hey, you need to go out and form an LLC to hold that real estate, or you need to organize your business as an S corp versus an LLC. Those are attorney conversations. I can give you, what I've seen in the past, but I try to be careful as far as, those are legal type questions that have tax implications and legal implications that I'd like to stay out of.
Hello and welcome to The Movable, a podcast dedicated to interviewing individuals involved in building manufacturing. I'm your host, Jaret Dory. Please enjoy. I guess maybe we can start just kind of introduce yourself, your career path to date, and, why and the how.
Yeah, that sounds good. First of all, thanks for having me on the podcast, the Movable Podcast. So this is exciting for me. I'm currently a commercial banker at First Interstate Bank, which is a kind of a regional type community bank, headquartered out of Billings, Montana, and we're kind of in the western half of the United States, minus a few of the states. My career path to getting here was not really like a normal orthodox type of a path for somebody getting into commercial banking. I accepted an internship out of college with a bank headquartered here in Spokane called Sterling Savings Bank. And I was going to be basically a credit analyst intern, which ended up being just about everything, like, moving cabinets within offices and running and getting office supplies and anything that was needed, like a normal internship, I guess. Making a long story short, I guess they decided to keep me around at the end of that. So I was doing a little bit more financial analysis after the internship and helping commercial bankers with getting loans across the finish line. And that part of the story is pretty traditional. Usually a credit analyst then becomes like a portfolio manager and then becomes a commercial banker in this career line. But within my credit analyst world, there was an opportunity at this bank to take basically a manual loan process and move it into a software platform that we would refer to as a loan origination system. And it's kind of something that back in 2011 was fairly new for the size of bank that I was at. And I got an opportunity to help lead that project. And so I got a pretty quick education in really the entire loan process from start to finish, because I was helping build all of the processes around it. So that was eye-opening. It was good to see, the front to back of that process, work with a lot of leaders, work with a lot of bankers, and get, in a couple of years, really get a good understanding of the entire process. From there, I had an opportunity to sort of pivot into commercial banking finance. So thinking about things like strategy and how do we incentivize commercial bankers and, tracking the finances for the commercial banking division. And I guess through all of that history that I've shared, I was able to get a good understanding of what I wanted to do. So the first 5 years of the career it's exciting because I like challenge, and it kept me motivated because there was always a challenge. But those 5 years really helped me understand, okay, what do I want to do with the next chapter? And I never liked the idea of being a commercial banker because I always thought of it as a sales role, and I never thought of myself as a salesman. But the more that I worked with commercial banking, the more I realized that's really my passion, is helping small businesses to achieve their goals. And honestly, there's no better way to be a part of small business um, than being in commercial banking. I mean, we see such a broad spectrum of industries and ways that people have found to make money. So pretty exciting. So I've been at this now for 13 years and have just really enjoyed interacting with really folks like you that have built small businesses into mid-sized businesses into large businesses. So it's been
So
quite a journey.
that's kind of interesting. That whole loan software uh, application, being involved in that, how that would you say that kind of almost fast tracked your learning? Like that's what it sounds like to me. It was like this like quick way to learn the entire process.
Yeah. Yeah. Normally, exactly. Yeah. So normally for folks to get a good grasp on the entire commercial banking process, it's almost like they need to be a loan assistant, which would be kind of, intaking applications and then ordering loan documents at the end of that process and sort of the administrative function. And also be a credit analyst at some point for a couple of years to understand the financial analysis, and then be a portfolio manager to get a little bit of a flavor for interacting with customers. And that process really would take maybe anywhere from 6 to 12 years for somebody to learn the entire process, right? So, but being part of implementing this loan origination software, yeah, in a couple of years, I was able to understand each of those roles pretty intimately. So
Yeah,
that was pretty
it's almost
unique
like
opportunity.
I read like you're talking about working with entrepreneurs. I read this book. Oh, it's called The Lean Startup. That's what it is. And they talk about like starting a company from scratch, but also like doing something new within an established business and like the thought process that goes there. And like I think one of the things when you are like in a startup, you have like a fast forwarded experience because you get to experience so much so quickly, even things that you're terrible at. But it sounds like you got some of that. Like you got that, like this is something new implemented in, yes, an existing business, but it's like kind of one of those advantages where like you get a lot of experience in less years maybe than in a traditional sense. Anyway, not to fixate on that, but that's kind of that's interesting.
Yeah, totally.
So you're talking about
Totally.
that. That's funny that you said, I know a guy that is probably kind of similar to you. And like, he's like a financial analyst and he ended up in venture capital and like, introvert, whatever, considers himself that. I don't know. Can you consider yourself that? But like never ever thought of himself as a salesperson. And then he's like, I get into it and like so much of it is it's just so different. When you excel at a technical skill, you often do get sucked into sales because yeah, there's people that do like basic sales of like widgets. When you get into things that are more complicated, you kind of have to be somewhat of a technical expert. So
Yeah.
it's fascinating. The more I run into people, it's like that's like a common theme. Like I wasn't a salesman, but now like I am kind of a salesman because of technical background or whatever.
That's a good point. Yeah, widget sales, so to speak, would be somebody with a really
Right.
really good skill set in
Like maybe
sales,
just cars,
in the nuts and bolts of
or
sales, can
like a
go sell
basic,
just about
yeah, like an
anything.
item that everyone knows what
Yeah.
it does. Everyone knows, like
Yep.
it's not, you're not like working from the ground up with something. It's just selling like on a repeat basis. So, working with small business owners, do you see any
Yeah.
common trait that's either funny or just like a good trait, or maybe could be seen as a bad trait too in general society?
Yeah, that's actually an interesting way to ask it too, because there are common characteristics I see in a lot of successful business owners
Mm-hmm.
that can be viewed as negative. Um, so I guess I'll try to explain it as I go, but I think that one of the common trends I see is the willingness to take risk. Um, is definitely a must, and willingness to sort of push the boundaries of what people would think as possible or reasonable. The other characteristic, which is often viewed negatively on the surface, would be they're not good at everything, not always hyper organized, but recognizing that they have put people around themselves to, keep those areas, like keep things organized, to keep their weaknesses in check, I guess, so to speak. And so putting key people around them that they trust helps to make up for that. But I think that one of the great characteristics of a lot of successful small business owners is that they aren't afraid of those weaknesses.
Right.
A lot of people would allow maybe a weakness to hold them back, right? But charging forward, getting people around them that can help with things that they're not as good at. And I say that people can look at that negatively because they can think, well, how is this person so successful when they can't even keep organized in such an
Interesting.
area, right? So.
I do think that there is, if I were to guess, there's some things that I have picked up that to the general populace, like a lot of small, medium business owners are like a bit nuts, like a bit bananas, in the sense of their gauge of like what is risk. Like I think risk is a definition, right? Like I don't think you should just go and gamble. Like I don't think anyone thinks that, but like I think there is just a tolerance of doing something different that people like have a fairly low tolerance, and probably those business owners just like don't see it as a risk at all. Like it's not that they're being risky in the eyes of others, they are, but they're not necessarily in their mind taking a big risk, especially if it's a need that they're trying to fill. So it's something that I'm
and I think the way that you view a certain risk is going to be completely different than me, right? Because of our skill sets and our perspective. Exactly.
I want to get into like the manufacturing, because I know you have some customers in manufacturing, and talk like in depth about what are the different potential financing options outside of real estate. Before we get into that, and maybe this is a better follow-up question to that, but I'm curious, like just the other day I ran into a fractional CFO, and he takes care of like everything financial, including potentially raising funds, whether that's through an institution like a bank or private capital, whatever it is, but also gets into operations. And like, if he has, some owners of a business, they will bring him on and he will help, the financial component, but he also gets into like operations and like different operating procedures, because they're just pushing sales and they're doing a great job, but he'll help kind of organize from obviously a fairly high level. He doesn't get into the details. Essentially, he gets involved in business strategy, he gets involved in like some sort of operating procedure for the business to operate on. Do you find yourself as a banker getting involved to a certain degree, like more than you ever dreamed you would have in a business's strategy? Or, like instead of me just coming like, hey, James, I want a real estate loan because I'm going to buy this. This makes sense. You kind of look over my financial statements and it's like, yeah, this works and we'll lend you the money. Do you get more involved? Like, do you find yourself getting more involved, or is there any benefit in that? Or is there a risk in that from like a financial institution, someone working with these different entrepreneurs?
Yeah, no, it's really interesting. It's there are risks to how involved you get. I'll explain a little bit of that later, but I think that I would say my best customer relationships are those where I am actually kind of part of their leadership team in a lot of ways. So, for example, if they're going to build a new manufacturing plant, how many times in that business's life cycle do they actually build a new building, right? So for a normal business, it's probably only once or twice in that owner's life cycle, right? And so when we develop close partnerships, as a banker, I'm brought in pretty early into those conversations, and it's something that the business owner has often never done before, right? They're very good at operating their business, but they've never built a building or financed a building, or maybe they've only done it one other time. So it's really enjoyable to work on those kinds of problems, right? Like be brought in early, add value where the owner hasn't ever embarked on a journey like this, right? So my best, if I looked at like my top 5 most enjoyable banking relationships, it's the ones where I'm brought in with the owner and maybe the CFO, and we're working through strategies together. It's hard to exactly define, but if we get too deep into recommendations from a accounting and finance and even legal perspective, there can be some liability to the bank and to the banker if we recommend something that actually ends up being like detrimental in some way, whether it's legally or financially. So again, hard to exactly draw that line, but there's definitely a feel as a banker where it's, hey, this conversation really needs to have your attorney involved to make recommendations. For example, if you're thinking about purchasing a new piece of real estate as a small business, I wouldn't normally tell you, hey, you need to go out and form an LLC to hold that real estate, or you need to organize your business as an S corp versus an LLC.
Yeah,
those are attorney conversations. I can give you, what I've seen in the past, but I try to be careful as far as, those are legal type questions that have tax implications and legal implications that I'd like to stay out of. But forecasting and choosing the right financing structure, especially in areas where people haven't done it before, are really exciting. That's some of the like investor real estate financing is a different world that I'm not very involved with. That has almost become a commodity over the years because investors have rinsed and repeated so many times that they know the process, they know what buttons to push. And so that process is totally different, where it's almost the banker is brought in to really fulfill a need, almost like a commodity. And some would argue with me on that, but that's
I can
my
understand that
perception of it.
So if a company comes to you and says, hey, James, we're just experiencing tremendous growth, and from everything that we can tell, we need to build a new building. And the reason we need to build a building is, because our operation is going to function so much better, blah, blah, blah. And we're going to have more output. You would get in on those ground level discussions on financial viability, and I guess that'd be the big one. Is there something, like, to me, it's like obvious that the bank wants to get paid. So they want the business to be able to successfully pay for construction. And so would a lot of it be like presenting best case proposals in knowing about the business, after learning about the business, proposing, the best case that suits the business and its cash flow and whatever else. And so you'd have to learn about the operations to some degree anyway, like you'd have to do some learning. And so there's like a certain amount of work. Like you have like obviously loans that are kind of your cookie cutter retail loans, car, house. They're pretty, like I said, cookie cutter maybe. obviously you could do a whole huge analysis on a business that's producing $300,000 in revenue, and it's probably not worth doing that. Is there a way that you can kind of vet, or maybe people won't even bother, but is there a threshold where you're like, it's worth my time and effort? Yeah, like the
Less
million plus
analysis
loan, or a business that does over
yeah.
5 million in revenue, or is there like a little bit of like, you kind of know when, or maybe there is like a, you do know when it's worth even entertaining, or how does it get filtered?
Yeah. This is a hot topic because so by the nature of how we get compensated, right? We have a base salary plus there's an ability to make
Mm-hmm.
more based on our volume, right? So there's pros and cons to that. Unfortunately, what that does is that does cause us to have to make a decision. Like if I'm looking at a $50,000 loan versus a $5 million loan, like which one do I prioritize, right? We're making those decisions. But what banks have done and tried to do over the years is create simple processes like expedited underwriting for smaller loans to where I don't have to dive in at the level of detail that I would for a larger loan. And there's some forms of scoring. Businesses have a credit score out there from all sorts of different agencies that at certain levels of loan amount, we can rely on some of those scores to make a quick yes or no decision, as opposed to going through all of their historical financials and doing a full underwriting that we would for a larger loan. So, I don't know. There's banks that do that really well, and others that struggle with it, trying to figure out, what does that lower end of small business look like in terms of trying to get efficient processes in place so that we are still serving those smaller businesses, because it's important. They become mid-sized businesses and large businesses if we take care of them the right way. So, but there is the time trade-off. Like I wouldn't want to be spending the same amount of time, just like the business decisions that you're making. You wouldn't want to be spending the same amount of time on a less profitable project as you would on a larger margin project. So, that's a one that still hasn't been solved.
So as far as
perfectly.
real estate loans, that seems like something that banks like because of the collateral. Obviously, there's still some risk involved because banks aren't going to operate whatever the real estate is. Is there like 2 or 3 main topics of discussion when someone's buying or building real estate for a business that kind of dictate the entire conversation? I guess what I'm asking is, like, with the little that I know, like, one conversation is cash flow. Like, if you don't have the cash to, pay overtime, that's an issue. And the other one would be just total cost of borrowing. What are there like a few main topics that drive every conversation, essentially? Like, you get down into different details, but like, are there a few that's like, these are the 3 things that we look out for?
Yeah, there's a few high level that happen on every single loan conversation and negotiation. And I think the way that I would boil it down would be, we are underwriting to our top 2 or 3 sources of repayment. So to kind of get into some nuts and bolts here, our primary source of repayment in an owner-occupied real estate loan is going to be the cash flow from the business operations, right? Jaret, if your business moves into a new piece of real estate and we give you a loan for that real estate, hopefully the cash flow of the business is what's paying our loan payment back every month, right? And so that's that's typically the primary on a term loan like that. The cash flow of the business is what the primary source of repayment is, right? If that primary source of repayment has problems, the business starts losing money, and the cash flow is no longer sufficient to pay that. That's why banks would take collateral. And so secondary source of repayment would be what is our collateral. And so analyzing the value of the property that you've purchased, right? We're required to get an appraisal before we go down that financing process. And so that's because if the cash flow has problems, then the bank does need to lean on potentially taking back that collateral and having enough value there to either sell the building to somebody else, have somebody come in and operate out of that building to fulfill the loan requirement. And then part of, it can either be considered a secondary or a tertiary source of repayment would be the personal guarantee from the owner. Usually in scenarios when the cash flow starts to have problems, we're working with owners that they have the wherewithal to step in and help that along, help the cash flow get through that sticky, whatever it is, sticky season, or they have willingness to step in and help in those scenarios, so that the bank ultimately doesn't have to take back that building. So those are kind of those are really every single loan that we're extending. Those are the primary topics that we're talking about. And then obviously there's subtopics within each of those, but it's identifying the sources of repayment and then identifying how strong they are or weak they are. There's some nuances between like a real estate loan and then a just day-to-day working capital type of loan or line of credit that would cause those sources of repayment to vary. But those conversations are always being had.
How much weight do you put on projections, if any?
Yeah, so that kind of gets back to your question about like if you're growing and you need to expand your plant operations. It's a lot more of an art than a science, I would say, because we wouldn't necessarily enjoy like if you build it, we will come mentality. Like your company has always been at 5 million in revenue, and you think that if you build a plant that you'll get to 10 with no other kind of backing to that. But if you have good reason to say, here's our projections and we will get to 10 million because of X, Y, and Z. Maybe we just signed a new contract with some large or mid-sized company in the area to deliver another 2 or 3 million next year,
right,
or deliver another 5 million in 2 years. If we can make a good case for, the historical operations have been at great margin, and then we have a really good case for what those growth projections look like. There are times when we can step in and say, hey, this makes sense to finance a plant expansion based on these forecasts and these projections. But it has to come with a good
right.
level of detail.
So something that I wonder if you could share without giving too many details, maybe an experience of where someone required lending, whether it's for real estate or like a line of credit, and they kind of knew where they wanted to go, but they didn't know exactly how. And you worked through a plan of like, oh, wow, the owner was shocked at what the financing opened up for their business. Or I guess I asked that because it seems like obvious to me. Like, I kind of know what interest rates are. I kind of know what terms are, kind kind of know what the amortization schedules are, whatever. You have a general idea, but I'm not doing it every day. And so I'm curious if there's something that like maybe an actual story, like you don't have to disclose like exact details, but where maybe the owner didn't realize the potential that was available to them. You know, they were hitting roadblocks, and then this financing just like, it's like, whoa, I didn't, you know, I thought it was going to cost more, or I didn't think I'd be able to get this, and I was more advanced than I thought. I hope that's not too out there of a question, but
Yeah. No. No, I like it. Yeah, I think one of my favorite conversations is, I guess maybe the best way to describe it would be matching duration of assets and liabilities. And maybe that'll make sense with a story here, but I had a customer that came to me and said, "Hey, I need an increase to my line of credit because we've got a lot of growth coming. It feels like we're just bumping up against our line every month, and I need an increase to, I need let's say $1 million increase to that line." And so we sat down and we had a conversation, and I start digging into, what's the real reason for the increase? I see typically when you need a line increase, it's because AR has increased, maybe inventory has increased, and it's sucking the cash out of the company until you're able to convert those assets back into cash, right? If sales growth is happening and AR growth is happening, it's sometimes inventory, although it's a little less desirable to just increase based on inventory.
Like you'd rather increase on AR. You'd rather increase
that would
on
warrant
AR. Is that what you're saying? Yeah.
Yeah. Yep, exactly. And so digging in with this owner, I'll make a long story a little bit shorter, but that essentially I uncovered that they had spent about $500,000 in cash about 6 months ago on a new piece of equipment, right? Which is, if you're following sort of the Dave Ramsey approach, which works for personal finance pretty well, you would think, boy, that was a good decision, right? We didn't finance that piece of equipment. We spent cash on it. But that caused, basically a series of events that was causing them to bump up against their line limit, when there really wasn't a ton of AR growth just yet. They were on a forecast to continue to grow, but the real reason here was that cash in the company should have been reserved for working capital, right? So what we did was we ended up just putting a plan together to finance that, or I guess you might say refinance that piece of equipment to get the $500,000 back into the company, which essentially reduced their line of credit balance and opened up additional availability for them to grow. That to me is a perfect example of matching assets to liabilities. So you think of short-term, or cash as a short-term asset. And if you take that short-term asset and you buy a long-term asset, you've basically funded a long-term asset with a short-term asset, right? Ideally, you would fund long-term assets with long-term liabilities or truly excess cash. So making sure that you're not spending operating cash that feels like excess to purchase long-term assets. And so, short-term assets like accounts receivable and inventory should be either financed with cash or short-term liabilities like a line of credit that's always revolving up and down. And then long-term assets like real estate and equipment should be financed with truly excess cash or long-term liabilities like term loans. So keeping that principle in mind keeps a company in a pretty healthy
Yeah, that makes
position on their
sense.
balance sheet. And those are not always super obvious
Hmm.
conversations to the owner, where we can add a lot of value with a fairly simple conversation.
It is an interesting thing too that I've run into because our equipment's not very expensive. But when you talk about $500,000 piece of equipment, like a lot of our equipment is like $40,000 to $60,000. And by the time you take the time and then like the terms you can get on that small of a loan, it's like, isn't really worth it. But when you get into half a million is a lot of operating cash. I just had a conversation with a friend that had a spray plane business, and he bought it from the original owner, and they were operating old equipment. And one of the pilots crashed, so I think he was fine, but the plane wasn't. And so he came to this point where he could go and buy another $150,000 plane. Um, but he was put in this position where he had to replace it. And he had the cash for a down payment on a turboprop, which is like 1.3 million. And the previous owner had never really looked into it. He just like, meh, whatever. And so he went and financed it. They were able to like get rid of 3 planes. It did the work of 3 planes. I mean, just everything about it was just insanely better. And he was telling me this because he had an employee that financially just really struggled to get it together, and he needed the Dave Ramsey approach. And so he actually told him, I'll buy you the Dave Ramsey thing. I'll pay for it. You
Yeah,
do it. And the guy, it worked. Like it totally worked. But what he was saying, he's like, if I had done exactly the Dave Ramsey thing in our business, they would have still been struggling with, old technology and whatever. And they didn't have 1.3 million to
yeah,
go and buy the plane, but they had a substantial amount. And I think that kind of goes with Dave Ramsey works for your end consumer, but small business, I'm not saying it doesn't always work in small business,
yeah,
but it depends what your skills are. And in this instance, the skills were a plane, like flying a plane. And it's like planes aren't cheap. And yeah, you probably could have hustled in some way, but you want to use your skills to the best of your ability at that time. And so to me, it's an efficiency thing at that point. So if you're leveraging it for production, Ramsey's leveraging it for consumption. He's like, don't buy that. Don't buy that because you're just consuming. But
yeah,
my friend, he was leveraging it for production. And I think
yeah,
that's where like Ramsey won't say it. He's got a business. Yeah, he's self-financed. He has a huge media, like media is extremely profitable and reach it has a huge scale. And he's got a very special skill. So for him to say he doesn't need debt for his business,
yeah,
that's fine because he has those skills. But like if I'm a pilot and I'm going to produce with it, I think there's like a big difference between credit for consumption and credit for production. And
totally.
I still think that small business owners can get
Yeah,
silly with debt. Like I think that there are some things that are really silly, or it's
yeah,
because they're financing consumption. So I think that's maybe a bit of a gray area. Like I'm buying this equipment to produce, but they're doing it for their own
oh yeah,
self-interest and consumption. Like our shop, it's really funny. Our guys would be like,
yeah,
we need a plasma table. I'm like, we do? Because when I do the numbers, when we buy the parts from a really big steel supplier that has all the plasma tables, we can't justify even training someone, like buying it, training someone, maintaining it. It doesn't pencil out. We don't buy enough parts, but they really need it, and it's because it would be fun to have, right? Like, and I think that is pretty common. That sort of thing. It's consumption, so I think deciding which is which, or knowing the difference, is pretty
yep.
important. Um, that was really good. I really like that. So
You made a good point here, and one last little thing. I think a CFO might explain this a little better than me, but if you thought about um, if you finance $500,000 piece of equipment with your cash, what are you saving? You're essentially saving right now maybe 7.5% interest. So the trade-off is, hey, I don't want to pay that 7.5% interest over time, so I'm going to use my cash to save that interest expense. When you're a growing company, though, let's say that $500,000 piece of equipment is going to generate another, I don't know, $2 million at a 15% net margin, right? You're going to be financing something at 7.5% to generate 15 to 20% in margin, and use your cash for operating expenses to get to that level of growth. So a CFO obviously is going to be better at analyzing that, but that's kind of the concept that I would say. And like you said, there's an unhealthy level of debt, but there's also some, maybe you'd call it arbitrage to be had, where when you take a loan at 7.5% to generate 15.
So line of credit, I think, is fairly obvious. Real estate and equipment loans, I say fairly obvious. I think I feel familiar. And I like your explanation of like a term loan and how that should be financed versus like how something like a line of credit would be financed, based on AR or whatever. We were going to talk earlier about buying a business, and are you comfortable talking about that? Have you been in? I'd like to know if you have any. Like, again, don't divulge details that you can't, that you shouldn't. But buying a business, I've gone down this rabbit hole of, and listening to podcasts on M&A, people in the whole M&A world. You hear all about SBA loans. I'm curious about if there's just conventional loans, and how, as a banker, like, you look at buying a business. And I don't know what you can tell me, but I'll have more questions. Is it something, I guess, that you know anything about? Maybe is the first question.
Yeah, it's interesting. So I've done quite a bit of it, and I'll be careful on specific details because I guess I don't want folks to think that it's something that we just, as a bank, that we just love going out and doing. But I have done, with conventional financing, I have done a fair number of business acquisition deals in the last 5 years. They're very specialized. Again, it's not highly desirable from the bank's standpoint. So we have to be very choosy on what we're doing. There's also a lot of regulation around it. The reason it's less desirable is because when you think about, if you were to sell your business, Jaret, it's not just worth the value of the assets, right? So you might have assets in your company of fixed assets of $2 million or whatever. I'm just pulling a number out of the air, but your business's ability to generate the cash flow from those assets is really what drives the valuation of a small business, right? So you might sell your company for like $5 million, and there's only $2 million of equipment, let's say, in your company, but somebody is willing to pay for, let's say, $500,000 a year in cash flow that your business generates, right? So there's a shortfall between when a bank comes and finances a portion of that $5 million purchase. There's going to be some shortfall in the amount of fixed assets that collateralize that loan. So that becomes less desirable for a bank, because, kind of rewinding to what I said earlier, is we look at the primary and the secondary sources of repayment. And so if we don't have full collateral coverage, we kind of don't have a secondary source of repayment. And so the primary source of repayment, cash flow, becomes that much more important, and the underwriting around that cash flow becomes that much more detailed and stringent. So there's ways to do it. It's pretty complex, and I don't know, layer that on with the emotion of buying and selling a business. And I actually really enjoy the process, but it's I would say I get a lot of requests to buy businesses, and I think I'd probably do about 20% of the deals that come my way.
Yeah, like part of what's interesting to me with buying a business is that I think is really advantageous of a bank being on board with it. And this is something I thought about. If I were just to buy a business and maybe I could do a deal with the owner to finance, or maybe just buy it outright, whatever. Something like that I've thought about is even to involve a bank on a small part of it where they're comfortable. I mean, they probably want to take more collateral than you'd like, but anyway, um, because of the due diligence, like I feel like, I mean, if you're a large enough business, yeah, you have CFO and whatever that like maybe has done M&A before and whatever, but I think you have to get to a certain size before you can afford to do that. So you either have to know it yourself or just take a risk that, that everything's in line as much as obviously you don't just close your eyes and hope for, but there is something to me that like a bank's due diligence is super helpful in the purchase component, because just like with real estate, right? Like, you could go and do a real estate deal, which I mean is pretty standardized maybe amongst realtors. The due diligence can be pretty good, but the bank's also going to do their due diligence, which I think there's a nice layer in that of like, yeah, the tax returns say this is what we think of that, like something simple like, I mean, it's kind of obvious when you think about it, but if a business just sends you their P&L and they're up for sale or they're whatever, a banker is going to ask for the tax returns regardless. Like, it's a really simple example, but like it's a level of due diligence that if you've never done it before, if you've never bought something, you might be like, oh, that's the P&L. Like that's what it is. And maybe you wouldn't order an audit or whatever. So, how does the SBA change it?
Yeah, there's enough guardrails in commercial banking that,
right,
obviously it's not perfect. There's loans that go bad, but there is an extra layer of comfort that, hey, my banker is on board with this deal and they've done a lot of due diligence alongside me. Yeah, as opposed to just going at it alone. But you're starting to ask about how the SBA kind of changes the equation there too. It's a lot. So the SBA program, you're probably familiar with it, but if anyone else listening is curious, it's a government guaranteed lending program, where, so this is specific to what we call the SBA 7A loan program, would be a program that we typically use if we're going to help somebody buy a small business, and it allows the bank to extend financing where if that loan went bad, then the SBA or the government would step in and make the bank partially whole for that loan. So they sort of quote unquote guarantee a piece of the loan that we make. So that provides some additional avenues for doing small business acquisition and doing some other maybe potentially slightly more risky loans to smaller businesses that are backed by the government. The idea was to encourage a little bit more financing for small businesses to help them grow and generate more business that way. So the trade-off is there's a lot more like documentation that has to be provided from the owner or the buyer.
So you're probably going to get better terms on an SBA. You'd be able to, consider more goodwill or whatever as an asset. I don't know. I don't know if that's accurate, but you're going to get better terms, I'm assuming, with the SBA, maybe a better interest rate, maybe a longer life. I don't know what all, maybe amortized over longer years. I don't know. But what, from like a bird's eye level, interest rate might be higher with a conventional loan from a bank. I mean, like you said, they're already not super interested in doing it, but the interest rate, I assume, would be higher than an SBA, and the loan amount probably smaller than what the SBA would offer. Is that like basically would be?
Interest rate on an SBA loan is actually going to be either
interesting,
equal or a little bit higher. But the trade-off is, like you were saying, they will allow for a longer term and amortization, which is going to bring your payments down, and they will allow for a higher advance rate. So in other words, lower down payment. On a conventional loan, we're depending on what the collateral is, we're going to look for at least 20%, if not more, down payment on the purchase price, whereas the SBA allows for typically 10% down. There's, as with a lot of government programs, there's a lot of caveats to that, but typically a lower down payment, longer term and amortization, and then the trade-off is, more stringent underwriting process and a little bit higher interest rate.
What is a typical SBA term and typical amortization schedule?
For business acquisition, a typical is a 10-year term.
Okay.
With 10-year amortization. Contrast that to a conventional acquisition is going to be like 5 to 7 year term and amortization. And, largely most small business acquisitions through a traditional bank do go through the SBA process. Because, like I said earlier, it's just a little less attractive to the banks, and so they want that.
Yeah.
SBA
that makes sense.
Guarantee. Yeah.
Yeah, interesting. It's funny, the amortization schedule. I had to do hand calculations on that in school, in college, like how we calculated that all out.
Oh yeah.
That's ridiculous. It's hilarious that we did that. But I mean, it was good for understanding, for sure.
So you're just wondering why I do that for a living?
No. I think it's really, in a different life, I could see myself doing what you're doing. I think it is super interesting, the whole lending process, especially like when you explain that one situation where cash was an issue. Obviously, profit wasn't an issue. They had the receivables. They had these different things. They just didn't have cash in hand for day-to-day operations. And then like that equipment purchase, like $500,000 piece of equipment, like a farmer probably never has that much cash on hand, and they'd never buy they'd always finance a combine. Not always, but like, it'd be just commonplace. But obviously this individual had some cash on hand, but it was better off used in operations than, I could see how that would be very rewarding to work with someone that has a good business, has profit, and is just, hasn't converted the profit into cash, and you're freeing up that cash. So I think it's something that we used to farm. And so we did, it was normal. You just always were financing tractors and these, capital intensive things. And now in the business that we're in now, I mean, the only thing we financed is our real estate. And so different businesses do have different demands. But I could see how that'd be super rewarding. It would be interesting to experience someone that had major growth too, and be a part of that. That'd be interesting. Like going through different cycles. I don't know if you have any stories about have you had enough of a life cycle with any customers that went from they were a very small business, like a few people, and they needed a line of credit to fill orders or whatever it was. and then buy equipment, and they like really ramped. Like it was a really big trajectory. I mean, obviously it's more like that, but do you have anyone that it was like, yeah, we did the line of credit, and then the next year we financed like this big piece of equipment, and they were just like really climbing?
Yeah, no, there's been several cases of that, and you start with a small line of credit, and you see the growth, and then finance a couple pieces of equipment, and more growth, and then you get into let's move from a rented space into buying our own manufacturing plant, and those are also some of the most rewarding partnerships that I have, and those are the same people that would bring me in to all of their strategy conversations and be part of developing that together, which is those are the relationships that it's like there's always bumps along the way with what happens with day-to-day banking, right? We've got technology has problems sometimes with the amount of transactions that are coming through a bank, right? There's always annoyances, but in large part, these are the types of relationships where, yes, that stuff happens, but like they're not going to leave for another bank because of just the history that we have and like the trust that we have for each other, and working through those challenges. We just kind of understand, hey, we're gonna work through those together and get things back on track. But those, being part of the growth and being a partner along the way are really rewarding and fun. So yeah, there's been a few of them.
Is it safe to say that kind of the mindset of scarcity versus the mindset of plenty isn't really the right word, but the customers that you have that are maybe the most profitable customers for you to have, they're your good customers, the one you want to keep, are they also doing very well? Like, I would assume that is how it is.
Yeah, because again, kind of back to, I think we talked about it really early on, is like, these are the owners who have recognized I'm really good at a lot of things, but I'm not good at all things. And so my banker is one of those people that I need to bring in when I'm talking about growth strategy, right? And my banker, I trust them, and I enjoy bringing them into those strategy conversations. And obviously there's more than the banker. There's other partners that are brought in at different levels for different needs. But I think the practice of doing that has made these people successful. And it's like, even cases like COVID, these companies made it through because they were constantly looking around them and going, okay, who do I need to talk to for this? And like, we're being asked to shut our manufacturing plant down, so we need to bring in our attorney to figure out are we able to actually keep the plant open somehow, or be talking daily with our CFO to figure out how much cash is running out the door during these times. And everybody goes through challenging cycles, but the owners that operate that way, like I described, are constantly making it through. And these are the companies that are around for 50, 60, 70 years. They've made it through the dot-com bubble. They've made it through the Great Recession. They made it through COVID. Not that they're like doing anything special, but they just, every time something challenging comes up, they're doing the same thing.
Do you think that they're really transparent?
And it helps them survive.
Like kind of vulnerable with where they're at?
Yeah, yeah, that's probably a good assumption. Because like the sooner you can just say, hey, we've got a problem here,
like,
and make it known.
The conversation that I've been having is like, how much do you protect your P&L? And that's more of like a small business. Like there's a lot of small businesses. The owner is the only one that knows their P&L. And maybe their banker sees it or whatever. But then it's like, how much is to be shared with the employees? And granted, there are things, if you don't understand it, you might throw employees off. They might go look for other work or think the the company's making way more money than it is, or they
Yeah.
don't understand what it takes for the company to operate, on a cash basis or whatever, like what profit is required.
Yeah.
But that does seem to be like a common thread is like openly vulnerable. And I know sometimes like sharing with the wrong people maybe can cause some issues, but definitely sharing with the right people, it's going to solve your issues. Because like you said, you don't know everything. So whether it's sharing an operational problem with someone that's really good at operations, or sharing a financial problem with like someone that's a CFO, or having someone review that in the business. And of course, there's just different levels of that. But so I have one quick question before I ask my last question. These business loans, that like the term, that's kind of similar to a equipment loan, isn't it? Like 5 to 7 year. It's like similar anyway. So my question is, I wouldn't have known this, but your podcasting kind of inspired my podcasting, or it really did. Kind of had some things come together for me. And I know that your podcast was based around is based around manufacturing, correct? And so my assumption is that that's kind of something that you found a niche in your world. Can you talk about like finding that niche, and if it was an interest, opportunity, a bit of both that kind of brought you into? Obviously, I assume you don't just do like manufacturing deals or with manufacturing businesses, but I'm assuming I'm correct in that. Yeah.
It's a large part of what I do. Yeah. Although I finance other industries too, but yeah, it kind of, the opening question you had was about career path. And as I was considering more seriously being a commercial banker, I was talking to a lot of people about, hey, it seems like there's a lot of different niches to get into. What should I focus on? And they just said, hey, if you can identify something that you're already interested in, like some people are really interested in investor real estate and figuring out the NOI and cap rates and projecting value and things like that. But find something you're naturally interested in already, and this commercial banking gig could become a career for you that you would enjoy, right? So for me, I just kind of like sat down and started just brainstorming on that. And I grew up in blue collar. My dad was a welder. He taught me how to weld when I was like 10 or something. We did auto body. We did a lot of hands-on things, right? And so I thought, okay, I think that manufacturing could be that niche. And come to find out, I don't know how much the general public is thinking about these things, but come to find out the Spokane region is like manufacturing is impressively prominent. And there are thousands of companies building widgets or building airplanes or what have you. And so it was just kind of this perfect storm of like, I happen to be really interested in it because of my upbringing, and it's something that I can have as a career in the white collar arena that I'm in. And so that's how I came across the interest in focusing on that.
And to get your first, like to develop your reputation, I guess. Was there some deals that came easily, or did you have to really search for manufacturing businesses that you wanted to work with?
Yeah, it was brutal actually. So I started the first year, basically, first year or two not meeting my goals, which it's not my personality is I always want to meet my goals, right, or exceed them. So first couple of years was a lot of cold calling, trying to just go out and meet companies. And as you know, cold calling is a brutal sport. And anyway, that part of like probably a year and a half in was when I came up with the idea of the podcast. as a way to just let's learn more about this industry and come in contact with more people. Not that they're going to be like short-term leads for me to just fulfill my commercial banking goals, but let's kind of set this up for the long term. So I just know more people. I get a little bit more understanding of the manufacturing world, and eventually that momentum just started to build. Companies were starting to refer me to other companies to do the podcast, which in a sense,
Mm-hmm.
You're being endorsed for that. At least you're being endorsed for something. It's a good positive momentum. And before long, it was then those podcast guests would reach out and say, "Hey, I've got this problem or this strategy that I'm considering, and my banker just retired, for example. And so what are your thoughts?" And so, yeah, more and more of those conversations just fed kind of more referral business, and it's built momentum on itself.